Hi, my name is Collins and I'm doing Peachtree Case A. Why is the T-bond return shown to be independent of the state of the economy, and is the return on a one-year T-bond risk-free? T-bonds are independent of the economy because the Treasury has to redeem the T-bonds at par value, which means regardless of the state of the economy, they're not affected by the rate of return. T-bills are not risk-free. Like all securities, they are subject to some form of risk. In the case of T-bonds, it's reinvestment risk, which is a risk that investors will not reinvest at the prevailing interest rate when the bond was initially purchased. The expected rate of return for all four options. The options we have to choose from are T-bond, TICO, Gold Hill, and S&P 500. The expected rate of return is a return on an investment as estimated by an asset pricing model, and it's calculated by taking the average of the probability distribution of all possible returns. So based on the calculation shown here, S&P 500 would be the preferred mutual fund to choose from because it has the highest rate of return at 15%. Standard deviation and coefficient of variation for all four options. Standard deviation is the measure of the dispersion of a set of data from its mean. The higher the deviation, the more spread apart the data. The coefficient of variation, on the other hand, is a statistical measure of the dispersion of data points in a data series around the mean. That is a ratio of the standard deviation to the mean. The standard deviation and coefficient of variation of TICO, T-bond, Gold Hill, and S&P 500 are as follows on the slide above, on the screen above. And in regards to which is better to determine a measure of risk, standard deviation is the case. The coefficient of variation is better to determine a relative measure of risk. And it is also better for this case because we have two different investments with different returns on average. And when risk is taken into consideration, the S&P 500 does not look as attractive as it did before. The T-bonds start looking more attractive with 0% standard deviation and 0 coefficient of variation. The TICO overall looks pretty good with a relatively low coefficient of variation at 0.8681 and a standard deviation of 11.72%. Now suppose an investor were to put together a stock portfolio by investing $10,000 in Gold Hill and $10,000 in TICO. The portfolio's expected rate of return would be 11.15%, standard deviation would be 2.89%, and the coefficient of variation would be 0.2592. It would be far less risky than the individual stocks. TICO's expected return on an individual basis is 13.5%, and the portfolio is 11.5%, whereas Gold Hill is 8.8% compared to 11.15%. The standard deviation is 11.72% and 9.09% respectively versus 2.89 for the portfolio. So the characteristics of these two investments that reduce risk are that the fact that it is diversified. I mean, you don't want to put all your eggs in one basket because that's one way you get killed in the market. And also, the two securities are negatively correlated to one another, which means as one goes up, the other goes down, and you could say it the other way around. Also, both portfolios are still pretty well diversified and are both better than the individual stocks, but they are not as the original 50-50 split. So it does seem that gold would do better in a recessionary period, whereas energy would do better when the economy is booming. Now consider a portfolio consisting of 10,000 in TICO and 10,000 in the S&P 500 fund. Will this portfolio have the same risk-reducing effect as Gold Hill TICO portfolio? The answer is no, it wouldn't, because they are not negatively correlated. They are in fact positively correlated with each other. Plus TICO would be a part of the S&P 500 again, meaning that there's a positive correlation. The portfolio between TICO and S&P 500 has an expected return of 14.3% and a standard deviation of 14.1%. In this portfolio, the correlation is greater than the one in the other portfolio because the risk-reducing effect is much lower than the one in portfolio TICO. Now, suppose an investor starts with a portfolio consisting of one randomly selected stock. What would happen to the portfolio's risk if more and more randomly selected stocks were added? Well, if more stocks were added, the portfolio's risk would decrease, but its expected return would stay constant. Now, the implications for investors are that they should diversify their portfolios by adding different stocks, as well as securities that are negatively correlated. That way, their portfolio is not one-dimensional, and then their portfolio doesn't get destroyed in the market if the market were to go down. Now, do portfolio effects impact the way investors should think about the riskiness of individual securities? Yes, they do, because once they become well diversified, they eliminate the risk that's diversifiable. This will then only leave market risk in the portfolio. Now, would you expect this affect the company's cost of capital? I believe so, because if the one they invest in has a return of 3% and another stock they could have invested has a return of 9%, then their cost of capital is 6%. This can be increased or decreased depending on the rate of return the individual stock gets. Now, the difference between total risk, diversifiable risk, and company-specific risk is that total risk is the combination of diversifiable risk and market risk. Market risk is risk that cannot be diversified away, and risk is associated with the market. Diversifiable risk is risk associated with a specific company and can be diversified away. And now assume that you choose to hold a single stock portfolio. Should you expect to be compensated for all of risk that you bear? The answer to that question is no. An investor will not be compensated for their exposure to the higher risk of a single stock. This chart here plots 3 lines on a scatter diagram showing the returns of the S&P 500, basically the market, on the x-axis, and T-bond, TICO, and Gold Hill returns on the y-axis. Now, these regression lines are called value lines, where slope is the beta, which measures the sensitivity of a stock in relation to the market fluctuations. The difference between the expected return and the predicted return is the distance between the plots in the graph and the regression curve. Now, there's 3 equations on this chart. We'll start off with TICO's equation, which is y equals 0.7x plus 0.027, and r squared is 0.9961, making r equal to 0.99. The T-bond, on the other hand, has the equation of y equals 0.08, and r squared is equal to 0, which makes r 0. Gold Hill has an equation of y equals negative 0.3867 plus 0.152, and r squared is equal to 0.7109, making r 0.8431. The required rate of return using the capital asset pricing model for TICO would be 12.20%. Required rate of return on the market is 15%. Risk-free rate of return would be 8%. And the market risk premium is the difference between the required rate of return and the risk-free rate of return, which is 15 minus 8%, which gives you 7. Risk premium for TICO is 7 times the beta of 0.6, which is 4.2%. The required rate of return on TICO is 8 plus your 4.2, which gives you 12.2%. And the security market line is the same 12.2%. Also, the slope on the security market line, in this case is 7%, indicates the degree of risk aversion in the economy, which defines whether the investors will be willing to bear the risk of acquiring TICO stock. The hypothetical case for TICO is if the inflation rate were to go up by 3%. Now, if inflation expectations go up by 3% above the estimation, TICO's required rate of return would also have to go up by the same 3%. Therefore, the required rate of return for TICO would move from 12.2 to 15.2%. Now, what happens is that the security market line shifts, and that explains the increment. If the investor's risk aversion increases, so does the market risk premium. So it rose from 7 to 8%, and TICO's required rate of return would increase based on the calculations stated here. And then TICO's beta rose from 0.6 to 1, the required rate of return would be 15%. According to the efficient market hypothesis, stocks are always in equilibrium, so therefore investors can never beat the market. This concept also states that the expected return of a stock would be the required return of such a stock. This concept also does not consider plant, property, and equipment, and despite whatever corporate decisions they make, stocks are still very valued because its price is a reflection of public information. And in the case of Jake Taylor and his company, he needs to consider acquiring personnel with knowledge on effective market hypothesis, because this hypothesis seems to work.